At some point in human history, someone looked at a small, shiny rock and decided it was worth a cow. The cow owner agreed. And somehow that arrangement became the foundation of every economy on the planet. If you think about that for more than 5 seconds, it is genuinely insane. But before we get to the shiny rocks, we need to talk about the system that money replaced. Because the system it replaced was a disaster. It was called barter. The idea sounds simple enough. You have something I want. I have something you want. We trade. Clean, efficient, no middleman. Except it was none of those things. Because barter has a fatal flaw that economists call the double coincidence of wants, which is a very formal way of saying that barter only works if two people happen to need exactly what the other person has at exactly the same moment, in roughly equivalent quantities. Imagine you are a farmer in ancient Mesopotamia. You have grain, lots of grain. Great. You need shoes. So you find the shoemaker. But the shoemaker doesn't need grain right now. He just got grain from someone else. What he needs is a new pot. So you find the potter. But the potter doesn't need grain either. She needs help with her roof. So you find the roofer. The roofer actually does need grain. Excellent, but he doesn't make shoes. He makes roofs. You are now 3 trades deep and you still don't have shoes. Your feet hurt. This is the problem money solved. The earliest solution was not coins or paper, it was stuff. Useful, widely wanted stuff that most people would accept because most people needed it. Grain itself was used as currency in ancient Egypt. Workers were paid in grain. Taxes were paid in grain. Debts were settled in grain. Which worked reasonably well until you had to carry your life savings to the market. In other early societies, it was cattle, which also worked reasonably well until your money tried to escape, or died, or ate your neighbor's crops and created a diplomatic incident. Cattle-based economies had what financial analysts would today call significant volatility. Shells appeared early and lasted surprisingly long. Cowrie shells, in particular, were used as currency across Africa, South Asia, and East Asia for thousands of years. They were small, portable, difficult to fake, universally recognizable, and importantly, they were not useful for anything else. This turns out to be a feature, not a bug. The best currencies throughout history have tended to be things that have no practical use of their own, because if something is useful, its value fluctuates based on how much you need it right now. A bag of grain is worth more when you are starving, and worth almost nothing when the harvest just came in. A cowrie shell is worth the same in a famine as it is in a feast, because you cannot eat it either way. Metal arrived and changed everything. Copper, silver, and gold were being used as currency in the ancient Near East as far back as 3000 BCE. Not yet in coins, just as weighed lumps. You would carry a lump of silver and the merchant would pull out a scale. Every single transaction involved weighing metal, which was functional but tedious, and also created a new problem. Merchants started shaving tiny amounts off the edges of metal pieces. A little here, a little there. By the time they had shaved enough slivers off enough transactions, they had quietly accumulated significant extra wealth. This was called clipping. It was, to put it politely, fraud. It was also extremely common. The ancient world had invented currency, and immediately someone had found a way to cheat it. Some things are timeless. The solution to clipping was the coin, a standardized shape, a government stamp, an official weight guarantee. The first coins appeared in Lydia, a kingdom in what is now Western Turkey, around 600 BCE, made from electrum, a naturally occurring alloy of gold and silver, stamped with a lion's head. The stamp meant something specific. It meant the king personally guaranteed the weight and purity of this piece of metal, which meant you did not need to weigh it, which meant transactions became dramatically faster, which meant trade expanded, which meant economies grew, all from a stamp on a piece of metal. The coin was not just a currency innovation, it was a trust innovation. The government was essentially saying, you do not need to verify this yourself. We verified it, we promise. For this to work, people had to believe the government, which historically has been hit and miss. Paper money is where things get philosophically weird. China invented it during the Tang Dynasty, around the 7th century CE. Merchants carrying large amounts of copper coins across long distances were getting robbed constantly. Heavy coins were inconvenient and dangerous to transport. So they started depositing their coins with trusted merchants in the city and receiving paper receipts. Then they started trading the receipts instead of going back to get the coins. And then, at some point, everyone agreed to just use the receipts as if they were money, even though they were paper, even though paper has no inherent value, even though the only thing backing them up was the promise that somewhere, theoretically, the coins still existed. This is the moment where money became a collective hallucination, not as an insult, as an accurate description. Money has value because everyone agrees it has value. That's it. That's the whole system. The coins in your pocket are not valuable because of the metal. Modern coins contain almost none of the metals they're named after. A nickel is not nickel. A copper is mostly zinc. They are valuable because you believe they are valuable, because the person you hand them to believes they are valuable, because everyone in the entire economy has silently agreed to keep believing this together. The moment the collective belief breaks down, the money stops working. This has actually happened. Multiple times throughout history, entire currencies have collapsed not because the coins changed, but because people stopped believing in them. Money is perhaps the only technology in human history where the technology is the belief itself. There is something almost funny about the end point of all this. Humans spent thousands of years developing increasingly sophisticated systems to solve the double coincidence of wants: grain, cattle, shells, weighed metal, stamped coins, paper receipts, printed currency, digital numbers in a database, each step more abstract than the last, each step further from anything physical. Until today, when the majority of money that exists in the world is not in any vault. It is not in any physical form at all. It is numbers on computers, agreed upon by banks, trusted by governments, believed by everyone who uses it. The farmer who needed shoes in ancient Mesopotamia could not have imagined this. He just wanted to not walk home barefoot. And the solution to his problem eventually became a global network of abstract numerical agreements that runs the entire modern world. Basically, money was not invented by a genius. It was invented by a lot of frustrated people who were very tired of carrying cows to the market.